Good afternoon. Tom, can you hear me okay?
I can.
All right, perfect. All righty, thank you for joining us, everyone, for this afternoon's town hall relating to this COVID-19 pandemic that we have going on today. We have allotted 2 hours of our time to allow for the influx of question and answers that are being asked. And up on the screen right now, you'll see our expert panelists. We have Kristi Weierbach for workforce, Phil Keeney for technology, Tom Moul for regulatory issues, Chad Bumbaugh and Steve Snyder tag teaming the cash flow bucket today, and Katie Boshniak leading up the human resources as our expert today. So just a few housekeeping items before I kick it off this afternoon. You can customize the webinar and webcam screen set up by using the drop-down arrows on the GoToWebinar screen viewer. In addition to that, all attendees will stay muted today as we do have a ton of questions and a ton of new information, even from last week, to go over this afternoon. And you'll see the buckets of the subjects that we would like you to label your questions with, so it makes it a little easier for the question and answer portion of the broadcast this afternoon. And I'll keep this slide up on your screen so you can easily remember which buckets we're going to break those up into today. So without further ado, I will pass it off to Tom.
Thank you, Katie, and thank you everyone for joining us again this week. We're really pleased that you're able to take time out of your busy schedules with so much going on to join us. We hope that you're all well and making your way through this the best that you can. We're happy to have 2 hours today to share with you, to give you some updates, lots and lots of new information since we last met last Wednesday. As Kaylee said, we'll follow our normal format where we'll give some prepared remarks and updates on what's gone on since our last session, and then we'll open it up for questions and answers. We'll get to as many as we possibly can until 4 o'clock today, but we know with the volume that has been coming in that we just can't possibly get them all in, but we are trying to reach back out to you by email with your questions, and we will try to have that completed by this weekend at the latest. As many of you know, when we met last week, we were in the midst of keeping one eye on the proceedings in the Senate as they were trying to push the CARES Act through, which did occur late Wednesday night, and Friday the president signed that into law. So there is a lot of things to unpack there that we will be going through today. We're hearing discussion already of round 4 of stimulus may be coming. We're not sure if and when that will be, but it sounds like that one will be focused on infrastructure. And I know one of those things that's kind of near and dear to these webinars is just building out bandwidth that everybody is pressing on these GoToWebinars, Microsoft Teams, Zoom meetings, and so on, and such. And I know last week that actually impacted us a little bit as we got rolling with things. So hopefully everyone can hear us well today. As the slide said when you came on, if you are having trouble hearing through your computer speakers, you may just want to go over to the phone, and I think that'll work a little bit better. As we always do, we note that things are moving very quickly, very rapidly, a lot of guidance coming out, so we're trying to give you what we know up to the minute, but we know in both of our last town halls we were no more off the air, and Department of Labor or other entities issued some further guidance. So we're going to keep you as up to date as we can, but know that it is going to be continuing to change rapidly as we move forward. As always, our Stambaugh Ness communication lines are open. Call or email your Stambaugh Ness rep at any time. We will try to get you the answers to your questions. Send us messages through the contact page on our website. We are answering those questions as well. And while we continue to work in our remote environments, we're keeping our channels open and talking to each other as much as we possibly can to share information. You'll be seeing emails from us. You'll be seeing updates on our website. I would alert you to something we're calling our cash flow triage, which Steve Snyder is going to be talking a little bit more about in his session to help you out with some of these decisions you're facing. We'll be pushing information, obviously, through all of our social media channels. We're on all the normal ones, Facebook, Twitter, LinkedIn, as well as, I think we may even be on Instagram. I'm not sure. We don't have any other specific webinars other than these sessions in the near future, but I would remind you that we did do 2 webinars last week specific to the software users, those that use Vision and Vantage Point as their platform. There was a very well-attended webinar last Friday. Earlier last week, there was one on the Azure platform. Those webinars are recorded and are available on demand through our website if you missed those. Our next session for the town halls will be next Tuesday, April 7th at 2 o'clock Eastern Time. We hope that you're able to join us for that. There will be reminder emails coming out on that. And I wanted to note that we have extended these sessions. Originally, we were going to go through April the 14th. But we're now extending them at least till the end of April. And I see a couple messages slipping up to me here that some people may be having some trouble hearing the audio through their computer speakers. Again, I would remind you, if you could, in your GoToMeeting or GoToWebinar panel that comes up, if you just flip that to phone call and use the call-in number there, I think you might have better luck on that. So again, getting into our team again today, I'm Tom Moul, Director of Strategic Tax Advisory Services. I'm going to speak to you about tax and regulatory issues. Kristi Weierbach will be discussing workforce issues with you, especially those things that revolve around unemployment and paid leave and such. But we are bringing Steve Snyder in, a director in our architecture, engineering, construction practice. He has been deep into all of these new loan programs with Chad Bumbaugh. You've all heard Chad speak in the last couple of weeks as well. Chad is on the line today. He doesn't have any prepared remarks. Steve's going to carry the ball with that, but I think you all have a lot of maybe interest and questions on what they have to offer. We do have Phil Keeney from our IT group available today, Katie Bachniak as well from our HR group. We don't have any prepared remarks coming from them today, but they are going to be on the line and available for the question and answer section. So without any further ado, we're going to kick it off this week with Steve Snyder, and Steve's going to take us through some of the cash flow issues. So Steve, all yours.
Thanks, Tom. Appreciate that. Unfortunately, you're going to have to look and listen to me instead of Chad Bumbaugh. He did such a great job the last few weeks. I decided to step in and help out as I could, and somehow ended up having to do this session live. So not sure what happened there. Actually forced me to pull out a real shirt instead of the sweats that I've been wearing for a couple of weeks working from home. But it's all right. This is good. So what I'm going to do today is I'm going to go through what has just passed Friday, one of the biggest pieces that everybody's most interested in, and that's the payroll protection program. The CARES Act created this program, which is essentially released a pool of funds to be allocated to help small businesses, to help keep the workers employed amid this pandemic and the downturn in the economy. So the biggest part of this that everybody's excited about is the loan forgiveness. So I'm going to talk about that a little bit. I'm going to kind of walk through what this means, who qualifies, what's the loan amount you can get, what are the details of the costs that go into the loan, the forgiveness, and a couple other things that, are part of the bill. And as Tom mentioned, this continues to be a fluid situation. The act is passed. The language in the act is there. A lot of what we're going to talk about today comes from the act, word for word in some cases. But of course, as everybody's aware, it's almost always up to interpretation. And you've probably seen a lot of blasts and blogs and videos, people talking about it. In some cases, it sounds factual, but I think we all know that the details haven't been hashed out perfectly yet. So there's a lot to come yet. And what we're going to focus on today is the actual language within the act. Hopefully, this brings some questions up. Please feel free to send your questions in. We'll do the best we can to answer them. and we'll go from here. So I'm going to discuss first about who qualifies, and that's essentially starts with any business or entities. You had to be in operation as of February 15th, 2020. You have to have fewer than 500 employees. This includes, your normal small businesses, 501c3s, veteran organizations, tribal business concerns, sole proprietors qualify, independent contractors, and anybody eligible for any other self-employed individuals, 1099s, that type. Businesses with a NAICS code beginning with 72, that's essentially the food services group. They are allowed to have 500 employees per location. Okay. Now note that this 500 count, this is a little different from the typical SBA identification of a small business. I believe that those are broken down by their NAICS codes as to how many employees would count to qualify a business under the SBA rules. That is not how this is applied. This is a pure count of 500. In addition, and some people have raised this question already as well, is how do I count if I have affiliates? So the SBA does have affiliation rules, and some of these are waived as it relates to food and services and franchise entities, but not for the rest. So those rules have to be followed when determining whether or who to include in your count of 500 employees. So how much are you going to be able to borrow under this loan program? 250% of your average monthly payroll costs during the 1 year period before the date in which the loan is made. And I highlighted the word made in my notes because we don't know what that means yet. I've seen some documentation out there from blogs and such saying the origination date of the loan. Not sure if it's going to really be by that date. Difficult to measure 12 periods ending on May 15th or May 12th. My guess is it might be a good month cutoff in the month end prior to the application, but we don't know that yet. So if you are going through and trying to figure this out on your own, I would suggest currently just to do an estimate to maybe utilize your monthly pay, your 12 period payroll costs from April 1st to March 31st. That might be your best bet right now to get an idea as to what this will be. And again, that'll all vet itself out once you talk to the bank and go through the application process. If you're a seasonal business, deemed to be a seasonal business, that is 250% of your monthly average payroll costs during the 12-week period beginning February 15th of 19 to June 30th of 2019. That's what you would use for calculating your average monthly payroll costs there. If you took, and this is just a side note, if you took a loan from the Economic Injury Disaster Loan, which is out on the SBA website, between February 15th, 2020 and 6/30/20, you can also add that amount to your total calculated payroll costs to then later be refinanced into this PPP loan. Okay, the maximum amount is $10 million. So if you do this whole calculation and it comes up to more than $10 million, they'll cap it at $10 million. So what are the payroll costs? This has been a good topic of discussion over the last few days as well. So compensation, which is made up of salary, wage, commissions, or similar compensation, including payment of cash tips or an equivalent. Payment of vacation, parental, family, medical, or sick leave that wasn't credited through the Family First Coronavirus Response Act. Your allowance for any dismissals or separations, payment required for provisions of group health benefits, including insurance premiums, retirement benefits, and state and local taxes assessed on the compensation of your employees. Those are what are in your payroll costs. Cost not eligible is any compensation over $100,000. Taxes imposed, withheld under Chapter 21, 22, and 24 of the IRC. Yeah, that is, I'm totally anticipating some clarification on this in the coming days. If you're interested and you really want to get in and read the Internal Revenue Code, you can pull up those chapters and read through to figure out what that is. I'm thinking there's going to be some tweaks to this language in the coming days. So I don't want to go too deep into that right now because we just don't know. Compensation of employees with primary residence outside of the U.S. is non-eligible. And any credits that you receive for the qualified sick and family leave under the FFCRA, also not eligible for cost when determining your loan amount. What can you use these loan amounts for? So once you get those loan amounts, they are to be used for payroll costs, as I just went through. Costs related to the continuation of group health care benefits during periods of paid sick, medical, family leave, your insurance premiums, employee salaries, commissions, similar compensation, that's all included up there in the payroll costs. Payments of interest on any mortgage obligations. This does not include any prepayments or payments of principal, prepayments of your principal on mortgage obligations. It includes rent under a lease agreement, utilities, interest on any other debt obligations that were incurred before the covered period. So note that your rent, your lease agreements, and your mortgage must have been in place prior to February 15th, 2020. Any new leases or any new mortgage debt that you took on after February 15th would not qualify as an eligible cost. Okay? So that's what makes up the total cost to develop the loan. Now, what can be forgiven? This is another one that's had a lot of discussions around how to calculate this, but I'm going to run down through what the Act says, and I'm sure I'll field some questions on this. So this is the sum of payroll costs incurred during a covered 8-week period compared to the previous year or time period, proportionate to maintaining employees and wages. And this will exclude any people with compensation over $100,000. Wages over $100,000 will be excluded. Plus, payment of interest on covered mortgage obligations, any rent obligations, any covered utilities. The covered period, I mentioned the covered period of 8 weeks. That period begins on the date of the origination of the loan. And this will probably be vetted out a little bit further as the guidance comes out and the SBA has a chance to fine-tune what the lenders are going to be looking at and how they're going to calculate the forgiveness. But as of now, it says 8-week period beginning at the origination of the loan. Your mortgage must be a liability of the borrower, is a mortgage of real or personal property, and was incurred before February 15th, 2020. And as I mentioned before, the rent is the same way. Must have been in place. The lease must have been in place by February 15th, 2020. So that's what your forgiveness, maximum forgiveness, would be calculated as. But there's limitations to this forgiveness, potential limitations. Your amount, the limitation of forgiveness, it comes into effect. You cannot forgive any amounts greater than the principal amount of the loan. Makes sense. Other limitations are going to be based off of any reduction of employees. This is measured by taking your total eligible forgiveness costs times the average full-time employee per month employed during the covered period, divided by, there's 3 options here, your average full-time employees per month from February 15th, 2019 to June 30th, 2019. So essentially you're comparing the same period this year during the downturn compared to last year at the same time. Your other option is to use your average full-time employees per month from January 1, 2020 to February 29th, 2020. Remember, it's a leap year. And then your option 3 is for seasonal employers, where you take your average full-time employees per month from February 15th, 19 to June 30th, 19. So similar to option 1, but that's how they have to measure it. So that's the reduction of employee limitation. The other limitation would be by the reduction of wages. This one gets a little confusing, but it's the total payroll costs and forgiveness calculation in the covered period minus any employee wages, whether the amount of any reduction in wages that is greater than 25% compared to their most recent full quarter. Okay, maybe I said that a little confusing, but any wages. All right, so a little confusing. The payroll cost from your forgiveness calculation in that covered period minus employee wages, where the amount of those wages reduced is less than 25% compared to their most recent full quarter. So employees with annualized salary or wage in 2019 in excess of 100,000 are excluded from this measurement. So there's some exceptions to these limitations too, because you're thinking, what if I laid off some employees during this period? I didn't know. If I had known this, I would have kept them on board. I reduced wages, I reduced salaries. In case you did anything like that, there's some exceptions to these limitations. So the correction, you still have time to make a correction for any layoffs or salary reductions that happened by reinstating them and making these corrections before June 30th, 2020. Now, I'm sure there'll be more guidance coming out on this in the coming days because your covered period may be over before June 30th, 2020. And if you bring people on June 29th, does that mean you don't have to worry about this limitation? I don't know that answer yet. I think that will all be vetted, and that'll come out here in the coming days. Got a question a lot of times from people saying, what happens to the debt that's forgiven? Typically, if you understand the rules on accounting, any debt that is forgiven, you typically would pick that up as taxable income. But the SBA has said that this income will be forgiven. This debt will be forgiven and not included in your federal taxable income. So no taxes at the federal level. We do not know about any states yet. States have yet to announce their intentions on how to treat the debt forgiveness related to the PPP loan. So the loan has some terms. So the terms of the loan are a maximum of 10 years, the maximum interest rate of 4%. There's no fees. There's no prepayment fee. You're allowed to defer from your first 6 months up to a year of payments. But understand that this is not set in stone by the SBA. This here will be determined by your lender. So whoever you're working with to get qualified and apply for the PPP loan, they're going to help you to set these terms. So talk to them. I'd suggest talking early. Find out what your bank's intentions are, your lender's intentions, so that you can understand what you're looking at for debt service in the coming years. For those portions that are not forgiven. Some other important items to note: there's no collateral requirement on these notes. There's no personal guarantee needed. There's no upfront fees, and these loans are guaranteed by the SBA. So if you're interested in this, you're going to need to apply at a bank, typically, or other SBA-approved lender. They're going to ask you, because this is going to be turning quick, there's some certifications you're going to need to make. Certifications that the loan's needed to continue operations. Funds are going to be used to retain workers, maintain payroll, or make some mortgage, lease payments, utilities. There's some certifications you're going to need to make. Certifications that the loan's needed to continue operations. Funds are going to be used to retain workers, maintain payroll, or make some mortgage, lease payments, utilities. There's some certifications you're going to need to make. that you're applying as the applicant do not have any other applications pending under this program for the same purpose, and that you're not going to be receiving any duplicate funds in any other programs. You're going to track, my suggestion here though is really to track all of your eligible costs. What we heard today is that the SBA is working diligently to develop a one-page application, a really quick, streamlined, consistent application to be used by all lenders so that the process can flow a little bit quicker to get money out. To do this, going into this process, it would be a good idea to know what your costs are that are going to be eligible for the loan. So you can start now in going through the calculations, doing the best you can to determine what they are for the period that you think is going to be measured. Then any costs after that, where you're trying to determine forgiveness, I would also track those costs. Any costs that you're going to be spending this money on, you're going to want to be able to substantiate later. So I would strongly suggest that you put any processes in place, procedures within your accounting group to track these costs diligently and maintain support so that you have a good basis for forgiveness and the support that you did use those funds to pay those expenses. It'll save you headaches later so that you're not fighting with the lender. I did spend it here. They're like, prove it. Don't have anything. I strongly suggest that you do that. Some other things for any companies out there that are involved with government contracting. Think about the impact to your contracts. There's a lot of government work that's still able to continue, anything related to defense. But there could be some impact to contracts that probably should be tracking and documenting. Anybody that gets a FAR overhead rate, you're going to see a spike in indirect costs more than likely. To help support the allowability of those costs, you're going to want to track those charges as well and document what the time incurred was for being idle, excess costs for facilities when nobody was there. Track all that stuff, document it to the best possible way you can. Any additional consultants that you're going to need to support any contract terms, legal advice that you're going to need to build up your case for any amendments or change orders to contracts. I'd suggest you get a good process in place to track all those costs as well. So the payroll protection program is probably the most attractive piece of financial help that is available to businesses right now, and that's purely because of the forgiveness of it. And the loan terms are pretty nice as well. But there's others that you should be aware of, and I'll touch on a couple here. One of the bigger ones that the SBA is providing is the Emergency Injury Disaster Loan. That loan is a pretty quick, easy one to do as well. Let me back up on quick and easy. There's a streamlined qualification process online that you can go to. If you haven't done this already, I suggest you go out to the SBA's website, www.sba.gov. Go out there, and they have a link there for the COVID-19 loans and help. You can go in there and you will find a link that says Emergency Injury Disaster Loan. Click on that, and it takes you into the streamlined application. If you've already gone through this application, let's just say a week and a half ago, when everything started coming down and the SBA did not have this other application up yet, I would suggest getting on the phone, calling them, waiting in queue for 2 to 3 hours. But what you'll want to do is you'll want to get that application merged into the COVID application. So you'll probably have to apply twice. That second application online is much quicker. you can get through that one much quicker. You don't have to provide all of the details. And then they can merge the two, and then they'll also ask you if you want to have the $10,000 grant that comes along with that loan. That grant is to be paid within 3 days of the funds being released. The act says, or the program says, 3 days after the application, but those funds that they're going to pay you with haven't been released yet from Treasury. So upon release from Treasury, they will then be paid out within 3 days. And that $10,000 is a quick grant, regardless if you're approved or not for the loan. So it's almost like a no-brainer. You apply for the emergency disaster loan and you apply for the PPP. That 10 grand will be used to offset your forgiveness on the PPP loan. Okay? Because that's already been granted to you. This loan under the emergency injury disaster loan does not offer any forgiveness. You can get amortization periods up to 30 years, which is a positive. It will require collateral and personal guarantees from any owners that are greater than 20% owners. But if you are approved, you don't have to take the loan. But it's nice to know if you get approved and you need the money at that point in time, you've already gone through the process. I want to warn you, there's been some scams going on. Been hearing about a few of these. There are websites out there that look similar to the SBA website. You want to make sure you are at the proper website, www.sba.gov, and you follow the link on that website to the COVID-19 page, where you will find the EIDL and the other offerings that they have. One of the other offerings they have is the SBA Express loan. So there's a potential for up to $1 million there to bridge the gap before you get your EIDL loan and your EIDL approved. They say it's a quick 36-hour turnaround, but you're required. You should be in operation before 2/15 to get that as well. And for any other ideas, I would suggest you go out and check out the U.S. Chamber of Commerce Foundation website. They list out all the states and different programs that are available in each of those states. I know that today we have over 500 people listening, and I know they're not all sitting in one state. So it wouldn't make a whole lot of sense for me to focus on the state stuff today. But I think that's a really good place to go out and start to look at what other types of tools are available for you to help with cash flow right now. So that pretty much covers everything I wanted to talk about related to the loan programs. A couple things I want to wrap up with are, please understand that our lawmakers are still trying to figure this all out. They got the act, it's all passed, they know what their parameters are, but they're still trying to apply the guidance, provide guidance, application forms, set up the processing system. If you think you're going to have this by tomorrow or the next day, you're very optimistic. I think this could take a week, 2 weeks, maybe even 3 weeks. And then even when it's in place, please be patient. There's going to be some kinks here. I think it'll be difficult for things to be super smooth right away. But with time, I think they'll get it all worked out. Because of that, I think you should be talking to your lenders as soon as possible. They won't have applications. If anybody you're talking to says they do have an application now, you might want to call somewhere else. They're not out yet. So cash flow management, because this is going to take probably a little bit longer to get in place, I think you're going to start to see cash flow dwindling. So cash flow management is very important right now. Last week, Chad did a great job going through our cash flow triage, where it kind of tiers out areas you want to focus on first to save money. You know, save where you can. Don't spend money frivolously just because you have it in your bank account right now. I suggest you go out to our website check out our COVID-19 page. And in there, you'll find that document that Chad went through last week, cash flow triage. Some tips on there, some you're probably already doing, maybe some you didn't think about. We tiered it in a model that we suggest starting with tier 1. Tier 2 is more in the debt area, taking out loans that you're going to have to repay. At the time we wrote that, the SBA, the PPP wasn't finalized. We didn't know yet about a lot. So you have to make your own decisions as to whether that belongs in tier 1 or tier 2. With debt forgiveness, I believe it belongs in tier 1. I think everybody should be applying. And then in tier 3, there's some ideas there, but we want to tell you to use those with caution. They can come back to bite you later, but they could help you in the very near term. Mentioned it earlier. Please start accumulating your information now to support your loan costs, what you want to borrow, and figure out a process to track your costs for the forgiveness calculation. Document. Best you can do is support those costs. Time entries on within your time entry, put in there what it was, if it was related to COVID-19, any relationship in that regards. Beware of scammers. As I mentioned, just beware. Scrutinize something that sounds too good to be true. Deal with your lenders, people that you're familiar with, and you should be okay there. And to provide some parting wisdom, taking all these loans, excluding the forgiveness side of things, can put you in a difficult position later, with debt service. Please be careful. Understand that you've lost revenue. You're going to need time to ramp up. We have some deferment periods to help you with that. But not all companies are going to be able to replace that revenue that was lost right away. So best measures are to try and right-size your cost structure now to match the change in your business that you think you're going to see after we come out of this. Without right-sizing, it's gonna take much longer for you to recover and fight through that debt service that you're going to take on. So just be prudent about those decisions that you make. That's it for me. I'm going to have to hand this one off to Kristi. And where am I doing this at? So, Kristi, I think you're up next.
All right. Great job, Steve. Thank you so much. As you can see, things just continue to evolve. We continue to get more clarity as to what is truly the intention of the law. And, at times it can be a little frustrating. So Department of Labor, specifically as we think about the paid sick leave, the extended FMLA, we received the, original act, and then they issued an FAQ document. Then last Friday, they updated that document. Yesterday afternoon, they updated it again. So what I'm going to do today is just give you a highlight of some of those key things that we received more clarification on, more guidance. It's still not helpful with every single scenario. So there is a level of interpretation that we have to do with it as well. But one of the biggest light bulb moments for me this week is that, last week and the week before, talking with clients, it was, okay, this is a 2-week period of time, maybe a week. It's kind of like a light switch, turn it on, turn it off. It'll just be a short blip within the whole year, right? Well, we're quickly realizing that this is not a short blip. This is going to be something that takes us a little bit longer to sort through. And the decisions we made last week, we now probably have to think about it differently. I heard on the news that Virginia extended their stay now to June 10th. So what does that mean? Does that mean that other states are going to follow suit? If I'm in a state where we really haven't been impacted and you can't truly understand the severity, is it going to happen nationwide? What's happening currently in New York and what's going to happen in Florida? So it is kind of like a moving target, and we're just trying to all work together to make sense and move forward in the best way possible, because there's going to be some hard decisions. And it's our hope that we're able to help you through that, navigate through some of those dynamics. So if you haven't done so yet, please go to the Department of Labor's website, look at the COVID-19 information they have. They have the FAQ, they have an overview of the Act, specifically for the paid sick leave and the extended FMLA. They have also published the posters that we as employers need to be putting in our organization. And you have to do it in each location. So if you have 3 or 4 physical sites, you're going to have to display the poster in each of those sites. If you're closed and you are not reporting to those work sites because the governor tells you have to close, then you'll want to make sure that you put it electronically on your intranet site or email it out. And then when you do receive the order that you can open back up, make sure that you do post those. So there's a nice colorful PDF, just print it out on regular paper, hang it on a bulletin board. You're good to go unless you want to get fancy and laminate it. But make sure you do that. You're supposed to do it by April 1st. If it's not done by April 17th, that's when they are not going to be as kind to us and impose some penalties. So if you have paper and pen in front of you, I want to share just a few key things with you that I want you to write down. So I'm getting a lot of questions about intermittent leave. What does this look like? If my employee is telling me they are trying to split duties with their spouse, a couple hours here, a couple hours there, how do I handle that to take care of the children, right? Help them with school or whatever. And I'm going to encourage you to look at questions number 20 to 22. Those questions should give you a lot of the information you need. The piece that you got to kind of weave into that is how salaried exempt employees are handled. FLSA, Fair Labor Standards Act, tells us we can't dock salaried employees unless it's a full day of pay. And in that circumstance, there's only a few occasions where it makes sense to do that. So you really want to take a look at those questions. Again, it's number 20 to 22 on the FAQ document by Department of Labor. And if you have follow-up questions or scenarios, please reach out. I'll definitely help you try to navigate through those over-layering pieces of legislation, if you will. The next one is about work site closures. So once you close a work site and you put somebody on layoff, they no longer have the ability to ask for the paid sick leave or the expanded FMLA. Now, once they come back to work, should they still be impacted because the school is closed now for maybe the rest of the school year into June, or if in the fall we see another spike and people are becoming ill again, that's when they could potentially lean in on that. So just be careful because this legislation goes all the way through to the end of the year, and employees can use up to the 80 hours for themselves or to care for another individual. And then they also have those additional FMLA weeks, 10 weeks that they could take up to care for their child. So that is discussed pretty thoroughly in questions 23 to 27 on that FAQ document. So take a look at that. Again, 23 to 27. Also, within the guidance, Department of Labor has now said, there is some documentation that you as the employer would like or should keep on file. And there's specific things your employee should be looking to provide to you as an employer, where initially they were saying medical professionals may not be able to give us the doctor's notes that we need. So definitely check out questions number 15 to 16. It gives guidance on what that documentation or substantiation should look like. There are questions in there, and I forgot to write them down, just how to calculate, a part-time person. So they're covered by the legislation. It's a prorated amount. So what amount do I pay? How many hours should I pay them? We've reduced their hours. Do I base it off of their current scheduled hours or prior? So you definitely want to hone in that area because, again, this only starts April 1st. So as people are coming back to work or you're still open, you're life-sustaining, and somebody might become ill, etc., you might have to take these into consideration. So one thing that we did get questioned on a lot is this expanded FMLA, is it on top of, is it instead of regular FMLA? So when you're thinking about the total amount of time that somebody can have off in a year, assuming they're protected by the FMLA rules, it is a 12 weeks total. So it's not like 12 weeks of regular for somebody who might be, on maternity leave, and then they get an additional 10 weeks because now they have to stay home with their child because childcare is not available. It is only 12 weeks total. So keep that in mind. That is answered in question number 44, if you need to refer back to that. Another big question was whether or not me as a small business are exempt from these rules, specifically the child care provisions of the expanded FMLA. And that is defined within questions 58 and 59. I don't think we have complete clarity on that, but it does a better job of telling us when that might be applicable. So if you have less than 50 employees and paying for this time away related to COVID-19 is going to potentially, create a hardship for you, you want to check out those questions. Again, that's 58 to 59. Kaylee, can you please forward to that slide that I had as an overview? I just wanted to point a few things out there. All right, great. So last week, we did not go in depth about the paid sick leave criteria, and we talked about it in our first one. You can find it readily available on the internet. But as I was talking here, I just wanted to have it up front so you could see it in front of you. So if you look there at the top section, that first bullet point is the one that's still causing the most confusion. And it appears that the Department of Labor realized how quickly this could cover a lot of people because of what the governors in some states have done. And so through the guidance in these FAQs, they have really narrowed that down, almost to the point I'm really struggling to find an example of where it might apply. So the only thing I could think of is, and this no longer applies because it just changed this week, but if you had a company in Maryland that was still fully operational, which we know they are now pretty much shut down, and that employee lived in Pennsylvania and they were under a stay-at-home order and they could not report to work due to that quarantine, isolation type of situation, that's where it might have fit. But again, there's never been specific guidance on the exact definition of quarantine, isolation, and a governor's directive. So again, maybe we'll get that this week. I'm not sure. So we got to do the best of our ability to try to handle situations as they come up. Again, if your work site is closed because the governor told you to shut down, that's handled in questions 23 to 27, where you now are putting people on a layoff status. So it doesn't really apply. Some of the questions we're getting are really surrounding the whole unemployment discussion. In the legislation on Friday that was passed, government said, hey, we're going to give employees $600 more per week. Well, that's pretty good, especially if you weren't even making that before you were laid off. So there really is an incentive for people to want to stay unemployed. My hope is that there's not too many that they really enjoy wanting to work. So we don't know at what point that'll get cut off if employees are asked to come back to work and they don't come back. What will that look like going forward? I think, as Steve Snyder said, the guidance coming out this week, we should have more clarity on that. So, it is an extra $600 on top of what employees already will receive. And it ends the end of July. So they have it for, quite a long period of time. So that's a good thing. And again, you just want to think about the layering of some of the other older provisions that we have when you think about, should I reduce employees' hours or should I just lay them off full time? Which would be better? When you lay somebody off full time, they can get usually the maximum allowed to them. But once they start doing a partial unemployment, it really is a balance of, did I earn too much and now I can't get any more benefit and I'm still, significantly hurt because I'm not receiving the compensation I normally would. So definitely is a delicate balance there. In Pennsylvania alone, in the past week, there have been over 800,000 claims submitted. So as you can imagine, it's a huge bottleneck at this point. And what I understand is that they're working to get the PIN numbers out to each person that claims. So that way they then can begin filing every 2 weeks to say, hey, I had lost the wages. How quickly they turn around those paychecks, I'm not sure. It could be several more weeks. So the stimulus check will help employees, maybe make a do until that comes through. So it could be a little difficult for employees right now. And you as the employer might be in a position to answer questions or just help employees navigate this, especially if they never saw the recession the last time or had to go through anything like this. So, we continue to stay in front of the legislation as best that we can. If there's anything we can do to help you, please don't be afraid to reach out to us. We really want to work together to work through this. Again, I think we have a little more time yet before we can get through it, but we're in it together, and we'll get to the other side of this. I'm confident, and so just hang tight, hold on, you're doing your best. And Tom, I'm going to be handing it over to you unless you believe I missed something. And while you're sharing your camera, I do see there's one point I wanted to make about employee deductions. So if you have employees that currently contribute to flexible spending accounts or to dependent flexible spending account, they do potentially have the opportunity to adjust that now. Normally, you can't make a mid-year change to that. So reach out to your benefit broker and explore that, because if people aren't having daycare, they're not going to be able to use up the full amount that, they potentially would be tucking away into their account. So did I miss anything, Tom?
I think you're good.
Okay. All right. Take it away.
All right. Well, thanks, Kristi, and thanks, Steve. That's just a lot of information to unpack, and I've got a little bit more for you, although I think a lot of the things I'm going to talk about we touched upon last week when it was speculated, and I just want to kind of emphasize some of those things that did come through the CARES Act that are certainly interrelated to both the things that Steve and Kristi had to talk about and really relate to taxes. So as we know, the CARES Act was signed into law by the President last Friday, March 27th. It's carrying a cost of about $2.2 trillion, just a huge relief effort here. And as we talked about, $349 billion for the small business relief in the way of the Paycheck Protection Program, the enhanced unemployment benefits, the $500 billion subsidizing larger industries, money's going to state and local governments, hospitals, healthcare, and so on. But an awful lot in there that also has to do with taxes. And probably the biggest item in there, the one that's getting the most attention, is the direct payments to taxpayers. We touched on it last week, but I'll touch on it again because I know there's lots and lots of questions about this. The government hopes to get these checks out to people, or I probably shouldn't say checks, direct deposits out to people if they have their direct deposit information within the next 3 weeks. They're going to use data they have from your prior year tax returns, potentially your 2018, your 2019 return. If you had direct deposit information there. If you didn't, we've been told there's going to be an online sign up. I don't have a lot more information about that yet. We will publicize that as soon as we get it so that you'll be able to go out and tell them where you want your check, or again, I said check again, your payment directed to. If all else fails, you will get a physical check, but that's going to take a little bit longer. So how much are these amounts? Again, they're $1,200 per individual, $2,400 per married couple, and $500 per dependent age 17 or younger. That's going to be phased out at higher income levels. For an individual, that's between $75,000 and $99,000 per year. For a joint couple, it's between $150,000 and $198,000. Although those limits are increased by $10,000 per qualifying child. So if you're a family of 4, your income can go the whole way up to $218,000 before you would totally lose the payment. The payment's going to be based on your 2020 tax return, which obviously is a little bit difficult to do right now since we're far from filing those returns. So they're going to use the information that they have on file. That sometimes presents a planning opportunity for you. If your income increased over the limits from 2018 to 2019 and you have not yet filed your 2019 return, you may want to take a pause on that and not file that return until you get your payment, because they will use the most recent data. If they use 2018, they issue that check, and it turns out that 2020 your income was really over the phase-out level, they will not ask for that check back. So if you had that situation where your income increased from 2018 to 2019 and you haven't filed the 2019 return yet, you may want to hold off on that. On the other side, if your income goes down and you don't get the advance payment, but you should have once you file your 2020 return, you will get payment with the 2020 return. You're going to have to obviously wait a little bit longer, but you'll either get a higher refund or will owe less when you file your 2020 tax return. As Steve said, as far as the SBA loan programs, I would also warn you to beware of scams in this program. We're already aware of websites, phone calls, things being made, people saying they'll assist you with this program. None of that is official. This is all being done through the IRS and the Department of Treasury. So please do not accept assistance or sign up for anything unless you know you're working with a trusted advisor on that can guide you in the right direction. These monies will go to everyone with a Social Security number. Now, that would include some lower income folks, maybe older people that are in a nursing home and such, that typically don't have a tax liability and maybe don't even file a tax return. They're going to try to reach those people through information they have, such as their Social Security benefits and whatnot. But if you are a little leery on that, it may not hurt to actually file a tax return for those folks for 2019, even though they have no tax liability. So I know this one's going to continue to kind of be front and center in the media. I'm sure when those payments are issued, there's going to be a lot of publicity over that. The CARES Act also had a number of provisions in it that help out employers. Again, the theme here, as it was with the payroll protection program that Steve talked about, with many of these other credits that Kristi's talking about, these other programs, are to assist employers in keeping their staff on board and keeping them paid. Two other items that go along with that are, one is the employee retention tax credit. This is a refundable credit versus employment taxes of up to 50% of the wages that you paid during this crisis. Now, I will give you a warning. If you are using the payroll protection program loan or even the emergency injury disaster loan that Steve talked about, you cannot also use this retention credit. And I think you have to measure that, but I think in most cases that loan is still going to be a better deal for you. But if you're not using that for whatever reason, you may want to look at this credit. To take the credit, you have to be able to show that either your operations were fully or partially shut down during the crisis, or that your gross receipts declined by 50% or more compared to the same quarter the prior year. If you have less than 100 full-time employees and you meet those criteria, all the wages you pay during those periods, and that would include the quarter where you measure the 50% decline or the shutdown, the whole way up until your gross receipts return to at least 80% of what they were in the previous quarter, or 12/31/20, whichever would come first. The credit is 50% of the wages per employee up to $10,000 per employee. So you could get a credit of up to $5,000 per employee. If you're over 100 full-time employees, you can only take the credit versus wages that you paid while you were on shutdown. So if you decided to continue paying the salaries of those folks while they were off, this credit may be available to you. A second employer assistance program that's out there is the ability to defer paying Social Security taxes, the employer piece of the Social Security taxes. That's normally a 6.2% charge for you on your employees up to an annual limit. This year's limit's a little bit in excess of $137,000 per employee. that tax can be deferred and pay 50% of that at 12/31/21 and 50% of it at 12/31/22. That would be the taxes incurred for Social Security from the date of enactment through 12/31/20. Again, if you're using the payroll protection loan or the emergency injury disaster loan, you cannot elect into this one as well. And I think I'd throw that one out with some caution. The immediate cash flow savings is going to be very valuable. Save that cash, pay it later. But remember, you will have to pay it later. It is going to come due way out there at the end of 2021 and 2022. So you need to be, thinking about that and making sure those funds are available at that time. In the case of both C corporations and pass-through entities, the net operating loss rules have been loosened. The Tax Cuts and Jobs Act that came about at the end of 2017 had made some changes to net operating losses. Previously, you used to be able to carry losses back 2 years. In some prior law, at times it was 3 years or 5 years. With the new law, you could only carry forward. Now, you can carry it forward for an indefinite amount of time, but there were limitations on how much of the loss you could use each year. In essence, the CARES Act has undone that. You can now take a loss back 5 years, a loss even that you've already incurred, maybe in 2018 or 2019. So if you lost money in 2018 and you haven't used that loss going forward, you can go back as far as to 2013 and recoup taxes that you already paid at the federal level. There's no income limitation either until we get out to beyond 2021 with this. So if you carry it forward, you have a loss here in 2020, you make money next year, you're going to be able to use this year's loss against that. So a lot of planning opportunities there. I'd certainly suggest if you've had losses either at the C corporation level or at the pass-through level, and they're going out to your shareholders or partners, that you have some discussion with your tax preparer and how you can best plan for that to generate some potential refunds for you there. In conjunction with that, there was another factor in the Tax Cuts and Jobs Act that said at the individual level you couldn't deduct more than $500,000 a year in losses from business entities, even if you had income from other sources, maybe wages, investment income. That has also been limited. So there's no restriction on how many losses or the amount of loss you can take, again, for 2018, 19, and 20. So again, if you got hit with that on your 2018 return, immediate chance to go back and amend that return and recoup some taxes. The ability to deduct interest expense on a business tax return with the Tax Cuts and Jobs Act was limited to 30% of your adjusted taxable income with a couple add backs on that for things like depreciation and amortization. So a heavily leveraged company may not have been able to currently deduct all of their interest expense and have it carry forward. That 30% has been increased to 50%. And very importantly, you can make an election for 2020 to use your 2019 taxable income to measure that. Well, why is that important? There's an assumption that 2020 income will not be as high as 2019, so your limitation would be lower. So trying to maximize the deduction for you there as well. There was a technical correction in this act for something called qualified improvement property. Basically, those are major repairs or improvements that you did inside a non-residential building. So your commercial buildings, your offices, your manufacturing facilities, your warehouses. There was a glitch in that Tax Cuts and Jobs Act that said those type of improvements had to be depreciated over 39 years. I don't think that was the lawmaker's intent, but there was an error in their haste to get that written and approved. Finally, we've got the correction, which reduces that 39-year depreciable life to 15 years. What's really important about that is this correction is retroactive the whole way back to September 27th of 2017. So any of these type of improvements you put in place since that date in 2017 are now subject to the shorter life. And even more important, a 15-year asset is eligible for bonus depreciation. That means it can be deducted immediately. So if you got minimal tax deductions for putting this type of asset in service since September 27 of 17, we now can go back and write the whole thing off. They may in turn create a net operating loss that allows you to take those losses back even further. So again, good chance that you might be able to come up with some immediate tax dollars helping out your cash flow. At the personal level, if you can show that you have been affected directly financially by the coronavirus, whether that's having yourself or a family member infected with the disease, or just being able to show financial hardship, you can now make a penalty-free withdrawal of up to $100,000 from your retirement account or your IRA. That money will be taxed to you over 3 years, or if you have the ability to restore that money during that time period back into the account when things get a little bit better, there will be no penalty for doing so and no taxation for doing so. Required minimum distributions for those age 72 and over are waived for 2020. You don't have to take that money if you don't need it and incur taxes on that. This is kind of a small one, but one that we hope people will take advantage of. It's a $300 above the line charitable contribution deduction for those of you who don't itemize your deductions. And for those of you that do itemize your deductions, no limit on how much you can contribute based on your adjusted gross income. Previously, you could only contribute up to 60% of your adjusted gross income. At the corporate level, those minimums have also been increased so that you can give a little bit more if you have the ability to do so. Also included was if the employer has the ability to do so and wants to help out employees with their own, not their family members, but their own student loans and educational expenses, they can do so up to $5,250 between the enactment date and January 1, 2021. The company gets a deduction for that, not taxable to the taxpayer. Steve made a little bit of reference to this when he was talking about the forgiveness on the payroll protection program, talked about those loan forgiveness amounts are not taxable at the federal level. I would repeat, the things I'm talking about here today, all these tax provisions are also at the federal level. We have to keep our eyes open what will be done at the state and local tax level. And we do have a team of state and local tax experts here at Stambaugh Ness who can certainly come up with those answers to you when they become available. We're waiting on many of the states to come forward with their guidance on how they will treat that. Just to touch on a couple of other things that we've hit in the past that where there's been a little bit of movement. One is on the tax filing deadline. I think probably almost everybody's aware that July 15 is the new April 15. Individual income tax returns, first quarter estimated tax payments are not due now till July 15. They did this past week add a couple of tax returns to that. One was the Form 709, that if you need to file a federal gift tax return, that has been extended to July 15. However, estate tax returns, the Form 706, that are due April 15, they're still carrying that April 15 due date. Also, beware, federal estimates, second quarter estimates due on June the 15th, still carry the June 15 estimated date. There's a lot of industry groups like the American Institute of Certified Public Accountants who are, again, continuing to voice their concerns with that with Congress and asking for relief. We may get that, but we don't have it yet. Also, be very cautious of your state and local tax filing dates. The majority of the states are moving their dates back as well, but some have not. I know Virginia is an example. The individual income tax return is due May 1st in Virginia, and they have not changed that. They're giving you till June 1st to make any payments that you owe, but they have not moved the due date on that. So if you're affected by that, if you file in Virginia, beware on that. Beware of other taxes as well, sales and use taxes, payroll taxes, all those other taxes that, again, traditionally are at the state or federal level, on whether those filing dates have changed or not. Don't miss out on one of them and unnecessarily subject yourself to penalty and interest. we've talked a lot in the past 2 sessions about the payroll tax credit that was a part of the Family's First Coronavirus Response Act that was passed back on March 18. Again, as Kristi said, the Department of Labor continues to bring guidance out on that. So if you are paying leave time under the Emergency Sick Leave Act, under the Emergency Family Medical Leave Act, there are credits available for you there. I'm not going to spend a lot of time on those today because we've hit them pretty hard in the past, but we certainly are open to answering any questions on those. And lastly, I would again remind you of something I covered in the last session, the qualified disaster payments. Just a reminder that if you are paying some things on behalf of your employees, maybe to get them up and running remotely from home, helping them out with some, non-covered health expenses, over-the-counter drugs and such, you can take a tax deduction for doing so under the Qualified Disaster Payment Program and not tax your employees on that. So again, if you have the means to, a nice way to help out your employees. So that's the end of my comments. I think that brings us to our question and answer section here. I think we have about 47 minutes to do so. So if I could ask everyone else to kind of come back here on the screen so you can see all of us. And we'll let Kaylee, I think, is going to ask us the questions and point them our way. So, Kaylee, when you're ready to start firing away, we'll do what we can to answer.
Alrighty. While everybody's getting their webcams up here, I just want to remind everybody that we do have Phil Keeney, who heads up our technology department here, on the line, as well as Katie Bochniak for some HR questions. Just so submit them in the questions panel of the GoToWebinar pane under the questions buckets that are up on the screen. And with that, I will start weaving through these questions here, as we have quite a few. Alrighty. So the first question is going to be for Steve Snyder. We sold a portion of our business July 1st, 2019, which cut our staff in half. How should we calculate our payroll?
You're on mute. Happens to all of us.
So your calculation of your average payroll would end up to be pretty high when trying to determine your loan amount. If you use the prior year, which includes, all the labor from that division that you sold off. So you wouldn't be incorrect in applying for a loan of that amount. But of course, when you go into the forgiveness calculation, you're not going to be able to get full forgiveness because your costs aren't going to equal 100% of the loan amount that you took out. There's nothing that says you can't do that because you can support all that stuff. But that goes to my one comment that I said at the very end, where you should be prudent in the decisions you make. And do you really need to take out that loan for that amount? Where you're not going to necessarily be able to spend it on those types of costs because you don't have those labor costs like you did in the previous year. So you can take out a lower amount of the loan and then potentially have it forgiven in full. So I think you would have to go through and model that out to determine where you would be. There's some variables that go into there. We're working with a couple clients already and helping them through similar scenarios and doing the modeling for them. Feel free to reach out if that's something you'd want to work through, but you definitely have something that's a little bit different than most people.
All right, and stay unmute there because the next two are for you as well, Steve. What is included in retirement benefits, i.e. matching, admin costs, employee contributions?
Yeah, that's not spelled out. It just says retirement costs. But I would think that your matching definitely would qualify. The admin cost potentially would qualify. Doesn't say that, but I wouldn't see why it wouldn't. Your employee portion, that is not going to be part of that portion of the formula. That's included in the gross wages when you're calculating your payroll costs. So that gets picked up. It's just done in a different area. I hope that makes sense.
All righty. And the next question is, what is your guess when they say what they mean about tax income adjustment?
I'm not sure. I don't know what that question is really trying to ask. Chad, if you're on the line, I don't know if you know what that might mean. Chad is around. I bet he's hiding now.
My thought might be in terms of just is that amount taxable, which I think both you and Tom touched on a little bit in your presentations, that forgiveness would not necessarily be taxable federally, and we're waiting on state guidance.
Unless the question maybe surrounds the difference between financial statements and the tax return as a tax adjustment. And in that regards, if that's what you mean, it would be income on your financial statements for GAAP purposes, and then be a tax adjustment for the tax return where it would not be income. It would fall under your M1. I'm talking like a tax guy. I'm sorry, Tom. But I think I'm right. That if that's what you're talking about as far as a tax adjustment, you would pick it up as income on your financial statements, but on your tax return, it's not shown for federal purposes.
All right, we'll give Steve a break here and we'll kick it over to Tom. So this question is for Tom. I saw where if you don't normally have to file a tax return, that you should file a simple form so they have your banking information. Is this correct?
That is correct. It's not required, but it is recommended. That is one good way to get that out in front of them, what your banking information is, and also just to get you, kind of in the system. We understand that anyone with a Social Security number is supposed to get the payment. But yeah, if you haven't filed a tax return, they may not know where to send that money. We do understand, as I mentioned also, that there is going to be some kind of an online, I don't know if it'll be at the IRS's website or the Department of Treasury's website, that you will have the ability to go in and put your bank information in, or maybe even correct your bank information if it changed from a prior filing.
Thank you, Tom. And another one for you. Does the advanced rebate payment, reduce someone's refund on the 2020 tax return, or is this truly a windfall?
No, it is a windfall. It is a payment that will be received by you either now or later, depending on the circumstance, but it is not taxable to you, and it does not have any impact on your 2020 or prior year return. This is, I guess you can just look at it as a gift from Uncle Sam.
All right, and here's a question for Kristi to give Tom a break now. If under 50 employees, are we required to do FMLA? I guess this question is basically not understanding the details of the exemption.
Yeah, so for regular FMLA, the same rules still apply. If you're less than 50, you do not now have to offer regular FMLA. But the expanded version, where it's covering somebody who has to stay home to take care of their child, either because school is closed or the child care provider is not available, that's where you might have an obligation. You might have an obligation with the paid sick leave as well. So again, I want to encourage you to check out questions number 58 and 59 on the Department of Labor's frequently asked questions, because it does detail a little bit further for us about how you can claim an exemption, especially if providing that coverage could create a hardship for your organization.
All righty. Another one for you, Kristi. What EFMLA forms will be required, and are those available or released yet?
I have not seen any new or updated forms. The FAQs do talk about the type of documentation you should look to obtain now, and that's covered in questions 15 and 16. So do your best to document at this point. Certainly, if they do create additional forms for us, that would be helpful, and we'll provide an update if that would occur. My thought is that they're doing blasts on guidance right now, interpreting the law that was passed, helping practitioners implement the rules and laws and so forth. One other thing that we do expect is that there'll probably be an updated version of like the Form 941. So I imagine in the coming month, we might see some forms fall out of this. We just don't know yet exactly which ones. So.
All righty. And another question for you, Kristi, just quickly relating to forms. It says, I'm a little unclear on what we need to post in our offices. Can you clarify?
Absolutely. Yeah. If you go to Department of Labor's website and you go to their COVID page, they actually have a section called posters. There's 2 PDFs available, one for the paid sick leave and one for the expanded FMLA. So all you have to do is print that out and post it in your physical location. Again, if you're closed due to the governor's mandate, then you can send that out via email. That way you at least have a receipt showing you tried to comply. And then also if you have like an intranet, SharePoint or something like that in your organization where you could post it there, that would be fine too. Just know that once you do open up your physical locations, you're going to want to post that with all your other labor law posters, because this does stay in effect till the end of the year, and you want to do it at each work site, not just corporate headquarters.
Perfect. Thank you so much, Kristi. All righty. So, Steve, this one's for you. When calculating or estimating a loan available and you have an ESOP contribution that gets paid one time per year, do we take the accrual of that for the current year, or what cash was paid out? We are a cash basis taxpayer.
That's a good question, because on your financial statements, if they're GAAP based, it's a loan. ESOP is a repayment of a loan of which you would have the interest that may qualify as an expense, an eligible expense. Because the contribution expense on the financials then is really a non-cash as it classes out your shares, unallocated shares. But if your application for this loan is based on a tax return, which is cash basis, that answer could be different. And unfortunately, I couldn't tell you yes or no, because we really don't know what the application process looks like yet. And that seems to be one of those clarification points that may come out. Nowhere in the bill did it mention anything about an ESOP, so it's not even specifically stated there. So hopefully items like that come out in the near future where we can get some good answers.
Alrighty, thank you. And another one for you, Steve. Will the forfeit amount be lowered if we eliminate 401k matching plans?
So potentially, you have your loan amount. When you calculate your loan amount, it's going to include matching. So that's part of the equation. The other part of the equation is how to calculate the forfeiture based off of your covered costs in that period. And those covered costs will not include the matching because you're not paying it. So that by default is going to reduce your allowable cost for forfeiture. It'll reduce your ratio that's going to be applied to your loan. So I would say if you did stop matching during the covered period, that yes, it would reduce your amount forfeited. You could model this out as well, determining, based on the application period, that covered period, you could reinstate your matching right before it, and then that matching would be then again included in your equation.
And Steve, if I could just add just a little bit to that. I mean, I think you're absolutely right that it will reduce your qualified payroll cost in that forgiveness measurement period. But if I understand correctly, the forgiveness in that case is not reduced unless the average compensation goes down by 25% or more. So as long as you're still paying those folks their normal wages, I would suspect just eliminating the match probably isn't going to throw you over that threshold.
And in that case, I probably would go with the other application process where you use your full-time equivalents, your people. If you didn't lay anybody off, then you're basing it off of a number of employees versus their actual wages.
Yeah.
And I just want to, while Kaylee's getting the next question, there's been several people asking about the link for that FAQ document I keep referring to. So I have put that into the chat area. I also put it in the question and answer section. So you should see that and should be able to copy and paste it for your records if you want to.
Thank you, Kristi. A question for Tom here. It says, I saw where if you don't normally have to file a tax return, that you should still file a simple form so they have your bank account information. That is correct. And I believe you already said yes, that is a good idea to go do. So this is a duplicate, correct?
Correct. And one thing I would add to that I probably should have mentioned when I answered it the first time is do be cautious when you file those returns. Make sure that if someone's assisting you with that, it's someone that you know and trust, because I think that could be a prime spot for, scammers and so on to come in and under the guise of helping you with that to get those refunds. So do file, but do file with someone that's a trusted advisor on that.
Okay, and another question for you, Tom. It says, what was the name of the last program that you mentioned? Qualified disaster.
This is a qualified disaster recovery payments. This isn't new with COVID. It's been around. It's often put in place when there may be a tornado or hurricane, some kind of other natural disaster. But when a disaster is declared, as it was by the president, I guess back about 2 weeks ago, it allows employers to provide assistance to their employees that otherwise would be a taxable benefit. If you're paying something that typically your employee would have out of pocket that's not a usual necessary business expense, you would usually have to put that on their W-2. This gives them the ability to do so as long as, again, you can relate it to it's allowing them to carry on their normal life or their normal work life as a direct result of how they were impacted by the pandemic.
All righty, and a question for Steve again. Can you please explain the $10,000 grant in further detail? Is this available to the self-employed who don't take out any other loans and have 0 employees? Is this available to the self-employed who file for unemployment compensation?
You're mute.
There's a reason for that. I don't particularly know this answer, to be definitive, but I do know that self-employed are eligible for it. If you go into the code of the COVID-19 application for the EIDL, you'll see there's a drop-down box that specifically asks if you're self-employed, and then it allows you to go through it so that you would be eligible. Now, just to make sure that this is clear too, the grant isn't a given 10 grand. It says up to 10 grand. So there is a potential for a prorated portion of that. Now, how that interplays with other programs outside of the SBA, I'm not certain. I think the only interplay is really with the PPP, but I think it's a legit question, but one I'm not 100% sure of that answer.
Okay, and another question. If you have dependents that are over 18 and they file their own return, but your AGI is too high to get the stimulus check, will your dependents be eligible for any of the stimulus funds?
If they are dependents, unfortunately, no. If they are ages 18 to 24, full-time students can be claimed on your tax return as a dependent. They will not get the stimulus check. It's kind of the same as with the child tax credits that's currently in the tax code. For whatever reason, they're kind of lost in the shuffle in that. Now, if they are age 18 or over and they are not your dependent, they're filing their tax return on their own, that they can make a case that they provide 50% or more of their own support, then they will in fact get the payment.
Thank you, Tom. Another one for you, Steve. If we reduce salaries in excess of $100,000 down to $100,000, would this have any impact on the loan forgiveness?
Yes, potentially. So it's a really good question. Unfortunately, trying to figure out the best way to say this. So it sounds like in the bill, it sounds like that employees that are over 100,000 are excluded when using the wages as the calculation. But we beat this around here at SN multiple times about, I can read that wording and it can go either way. It's like excludes employees that earn 100,000 or more, or it excludes the wages over 100,000. So I think you're going to get more clarification in the future on how to treat that. But in your situation, not knowing what that is, and if you really want to know those answers sooner, this is another potential opportunity for you to model this out, the what-if scenarios, trying to determine what happens if it is excluded, these people are excluded, or if it's just their wages. But it's the wording is just too what's the word I'm looking for? Ambiguous, I think. It's sorry, I can't answer that specifically, because that would be committing to what that wording in the act says, and it's just too crazy. It's too nebulous. That's a good word.
All righty, and another one for you as well, Steve. Are employees that are already on leave, do they count in the FTE number for forgiveness formula?
They're on leave. So I'm assuming that doesn't mean laid off, that they're on sick leave. They would be included in the FTE count, I believe. Kristi, would that be true? Nod your head, yes or no.
With respect to the loan, okay. I'm not sure.
Well, I'm thinking about the calculation of a full-time equivalent. So if they're on sick leave, they're getting paid. I would assume that they would come into that equation and they would be paid. They're on PTO, the family leave, and they're getting paid. They would be part of that calculation. But if they're laid off, they're not.
Yeah, one thing that they have said is for employee count, if somebody's requesting the paid sick leave because of COVID, it's at the time that person requests the leave that you do the determination of how many employees you have. So I don't know if that marries up with this whole loan thing, and I'm not sure.
Yeah, the loan thing doesn't specify that situation. So
yeah,
it could come down to the lender's discretion when doing that calculation.
But I think, this is Chad, just to add, I think they'd be counted in the base last year if they were employed last year, your starting point in the forgiveness, though.
That makes sense.
Right.
They would have been in last year's discount.
All right, I'm getting another question up here. This is like another cash flow question. We do payroll on the 15th and end of the month. I assume timing is going to be very important to hit 4 pay periods in 8 weeks if the funds have to be used for payroll during those 8 weeks. Can you clarify?
I wish I could. So that was one of the scenarios I was going through the bill looking for, and as we mentioned that it doesn't say anything about biweekly, semi-weekly pay. It doesn't say based on accrual basis versus cash basis. It doesn't say any of that. So it may come down to your it may come down to the situation where what are you using to apply and substantiate your loan amount. It might be best to take a weekly average for these periods to come up with your average payroll on the accrual basis. I think that might be the best way, but again, it'll be the lender's discretion what they want to look at, tax basis, which is cash, or your accrual basis on your internal financials on your books.
So I've got a question for you guys. I'm putting you on the spot here. So like with the Department of Labor, with the paid sick leave and so forth, we have the FAQs that continuously get updated. When you have a legislation like this come out, the CARES Act, is there something similar that we can expect that'll continuously be updated? Do you know?
Well, the U.S. Senate Committee put out an FAQ 3 days ago, something like that.
Okay.
It was good, but it doesn't cover most of these questions as of yet. My guess is that we're going to see more of that come out. It's just not coming out as fast as it is for you.
Yeah, and I think, Steve, and I think what we actually saw in that document that I think actually confused the matter more is some of the language in that document conflicted with what's actually in the bill. So I think maybe they were trying to say what they meant in the bill, but I think we'll continue to need some clarification on that.
Yeah.
And that's unfortunate too, because a lot of these questions are really good questions. They really are. They're just not. We just don't have the clarification yet to definitively answer them, which is frustrating.
This is Chad. Can I just?
It really is.
Go ahead, Chad.
Go ahead.
Just one or two quick things on that. I did listen into a brief webinar update. It sounds like there's a one-page application for the PPP that's working its way through the banking system to standardize that. So I don't know if those further kind of Q&As are going to come after they get the application process up and running. I mean, that's really been the goal, is to get the cash moving out to businesses. So they might start to refine and really focus on clarifying those questions after the spigots opened. I did see somebody made a post in the Q&A that they saw that the application was released. I've not found that yet, but that is consistent with what I heard is what they're working toward, is getting that one pager out for folks.
All righty. Next question here. What is included in medical benefits and that are included in the reimbursement? Is it just medical, or can it include other benefits like dental, life, vision, etc.?
Another one that wasn't specifically spelled out either. But these are employee costs. So logically, it sounds like they should be in there. I would probably model it out to include those in both sides, even in the forgiveness side, so that you're at least apples to apples. But again, it's when you get down to the application side, I think that's where you'll see whether you can include it or not.
Okay. Another question is, are the paid leave entitlements allowed to be used intermittently? And if so, can it be used for 80 hours that extend beyond 2 weeks?
Yeah, go back to the FAQ document, questions 20 to 22. They talk through a few different scenarios where intermittent leave can be used. There are a few instances where it cannot be used. And I don't have it memorized, I'm sorry, to be able to talk through those off the cuff here. But yeah, there is some ways in which intermittent use can be done.
Okay. How do we calculate the cost of health insurance for purposes of the loan if we are self-insured?
I believe that the self-insurance costs are included in there as well. So anybody that's self-insured understands that this is a moving target from month to month. So when you're calculating out your loan amount, you're looking at an average over a year. But then when you're looking at your covered period, it could be high, it could be low, it could be all over the place. So I do believe you would use your actual claim costs that would come through that you would record on your P&L.
Okay, and another one for you, Steve.
That's a belief.
Steve is the popular one with the questions today, so I apologize, Steve, if you need to get a drink.
Kristi's loving
this. You're it.
So here's another one for you, Steve. In the Paycheck Protection Program, there was an exclusion in the calculation and forgiveness of salaries for employees of $100,000. This got cut off. Is that they require person's salaries or only the portion over the $100,000 exclusion? Also, how are bonus payments handled in this calculation? Can they be included?
Okay. Might even know who asked that question. Still,
you know him well.
Great. Okay, maybe not. So great question, and I've heard this one before. The interpretation of employees being included or excluded that make over 100,000, is it totally excluded, or is it the wages in excess of 100,000? Up for interpretation. I wouldn't want to be definitive one way or the other. My read on it is that it's wages over 100,000, but it's worded a little bit different in the bill where it makes it sound like they're excluded from the forgiveness calculation. The question on the bonuses, to me, that's compensation, payroll, but it's often part of timing as well. So this, I would say it should be included based off of what I've read in the Act, but during the application process and as it gets vetted out, there is a potential that these types of costs could be excluded, which I could understand. They are maybe not totally thought of in the process and a good way to maneuver around and get your calculation to work the way you want. So it's possible they may be excluded later, but I think they're included in the language now.
Thank you. And this is an FMLA one for you, Kristi. If an employee is exempt and teleworking but needs to reduce her hours worked because her child is at home due to child care closure, is that employee eligible to receive intermittently some of the 2/3 paid sick leave and emergency FMLA leave?
Yeah, it's really tricky when you talk about salary exempt employees because according to the Fair Labor Standards Act, an employee works 38 out of 40 hours. You can't deduct them for those hours. It's no different if they work 42 hours. You don't pay them extra for the additional hours. So there are some cases where you could deduct a full day worth of pay if that person made themselves unavailable. But the whole premise with telework is that you have the flexibility to work when you can, when you might be available. So whether that's first thing in the morning while the kids are sleeping or, at night when they go to bed on the weekend. So it's really up to the company and the employee to work out an arrangement. Again, looking at questions 20 to 22, it does talk about some of the ways where you might be eligible as an exempt employee, but it's very limited just because of that overarching Fair Labor Standards Act about how salary exempt employees have to be paid and treated.
Thank you, Kristi. Another one for you, or I guess, Steve, possibly. If employees are laid off, can they be brought back to work using the PPL? As in, can they be brought back to work and then counted in the payroll for 8 weeks?
So that was one of the things I talked about. Yes, there is a exclusion to the limitation calculation by essentially making things whole again. And you have until June 30th to make your workforce whole. No clarification on how that works. There's a lot of different scenarios that we've talked through about your 8-week reporting period may end before June 30th, or it may end way after June 30th. What point when you bring back these employees, and does it count? Do they have to be on staff for a certain amount of time during that period? There's no clarification in that regards, but according to what you're reading from a generalistic view, it does allow you to make those corrections by bringing back your workforce and making yourself whole so that there's no potential reduction in your forgiveness.
Okay, one for Kristi. The FLSA allows for salaried employees to be deducted for unpaid FMLA. So don't you think it may follow that FFCRA will become an exemption?
Again, it's whether or not the time is in whole day increments, where unpaid FMLA is typically whole day increments. There may be some situations where it's partial day, but again, you want to look at the FLSA rules and just make sure you're not violating any of those when you're considering reducing pay for an exempt employee.
Alrighty. So this is kind of a scenario question for you as well, Kristi. It says, our scenario is this. Most of our employees are salary. We have a work from home order from the governor. We have CAD designers and engineers, and we are still working on projects from home. What type of benefits would they be eligible for? A few of them have children that they are taking care of due to school closures, and I'm having a hard time wrapping my head around if they would be eligible for the paid time of 80 hours because we are required to self-isolate.
Right. Again, you have to lean on the Department of Labor's guidance for teleworking. So when employees have the ability to work from home, even if it's in a reduced capacity as far as not a full 40 hours per week, they now are excluded from the paid sick leave. So it's really important to look at the Department of Labor guidance specific to your situation because it's a really tricky slope. I believe they are really trying to narrow down who qualifies for the paid sick leave because initially it really opened Pandora's box, if you will, and was really wide. And the Department of Labor probably realized really quickly that more people would be eligible for it, thus putting another burden on to employers. And if they do take the payroll tax credit, then that leans back on the government, who would have additional money they'd have to put. So there are a couple of things at play here. And again, telework, if they have the ability, work out an arrangement that you can get them to their full 40 hours, hopefully, or pretty close to it. So they're fulfilling their requirements for quality and quantity of work to put out.
Alrighty. This one is a cash flow question for you, Steve. It says, for the FTE count for the PPP loan, staff on unpaid maternity leave would not be included as an FTE during their unpaid leave time, correct?
I would think so. I think that's correct. I don't want to answer that one 100% because I'm not sure how the FTE is really calculated at this point. Hopefully, that all comes out later with clarification, because it's all intertwined with a lot of what Kristi is talking about as well.
Okay, and kind of along the same lines there, if employees are staying home on their own, do they count in the FTE calculation?
Are they being paid? That's I guess part of the question is, if they're not getting paid and there's no expense there, there's no wages that should probably not be factored into your equation.
Okay. And I'm sure this is probably for Kristi, for a workforce perspective, what if the company is open and employees are staying home on their own accord?
Employees that stay home because they're scared more than likely will disqualify themselves from unemployment, and they are not eligible for the paid sick leave because they don't meet the criteria defined as part of the act. And I'm trying to find the place, which question applied to the telework and the salary, because I know I'm getting some pressure about that, about salary exempt and so forth. And I remember reading the Department of Labor saying that generally you can't reduce the salary person, their wages. So I'm trying to find that here for you if I can quickly.
Okay, so I'll get a few questions for Steve out there so you can look that up, Kristi. So Steve, this one's for you. If we are unsure at this moment if we will need the PPP, should we still apply or should we wait?
There is a limited amount of money available. I mean, it's a lot, but it's limited. You can always apply and then not take the loan. So it's not like you have to take it. You can apply, get approved, and then make that decision. If you get approved and you've done your due diligence to calculate out what the forgiveness part of it is, then maybe it makes sense to go through that process. Making the decision ahead of time not to do it, I can't answer that question without understanding the full situation and ability to keep the doors open and keep the business alive and all that. Much more goes into that decision than just a yes or no answer. Sorry.
Alrighty, here's another one for you, Steve, as well. The debt forgiveness is non-taxable. That is pretty clear. Any question about the expenses paid with it? Are those fully deductible?
The expenses paid with it. So the expenses paid. Go ahead.
This is Chad. I haven't seen anything where they would make you disallow the deductions that you would pay with those funds. So in essence, if you get $100,000 to pay for payroll, that you're forced to disallow the deduction for the $100,000, in essence, making it taxable. The only thing the Act says clearly is it's excluded from gross income. And it seems to be the intent is to get the cash to the businesses as soon as possible. So I think if follow that logic that they would not disallow those deductions. But again, it's pure speculation at this point.
Yeah, I would agree with that, Chad. I mean, to not allow the deduction, which would effectively make the grant or the forgiveness taxable, because they would cancel each other out. So I again, as Steve said, we don't know anything with certainty at this point, but I think logic says that those expenses would continue to be deductible.
Okay, I have another question for, let's see here, Steve. This is relating to the 401k again. In order to save expenses, we are considering to discontinue the employer match for the 401k. If this is included in the total payroll cost, then we should probably continue with the match, correct?
Probably. Remember that if you're looking to cancel that, you're looking to you got a cash flow mentality at this point, trying to preserve cash. Not knowing the scenario, not knowing how much cash is sitting back to be able to maintain a business going, not knowing when you're going to be able to receive funds from the PPP loan, that all could come into play, because maybe those couple bucks you save from the match is what you need to make it that far. I would say definitely stop the match if that's what you need to survive. But if you have some money, sitting back and you're able to maybe continue with that, model out what you're projecting and see how long you could go before you got to cut it. Maybe that'll get you into your covered period and allow you to maximize your forgiveness. Sorry, it's not a yes or a no answer, that's for sure.
Alrighty, and another one. If employees had already been laid off, but you want to bring them back onto payroll and apply for the PPP, is that retroactive to when they took off, or does it start from when they are brought back onto payroll?
So your loan calculation is based on the previous year, so that doesn't come into play. Your covered period costs are all of those have an exclusion in that if you bring back people during or before June 30th, it's as if they weren't gone, I believe. And that's the piece that we're not 100% sure of how they will apply that exclusion. When you bring them back, we don't know that yet. But there definitely is going to be an exclusion for that. I just don't know what the timing of it would be.
And Steve, I believe it also says that the 8-week measurement period for the forgiveness begins on the date of the loan. So it probably wouldn't make sense to settle on the loan or take the loan while you still had the folks laid off. If you know they're coming back prior to June 30, you may just want to settle on the loan and trigger the 8 weeks from that date.
Yep, agreed.
Okay. So it says for the $100,000 payroll limit, are they talking gross pay or taxable wages from box 1 of the W-2?
Doesn't say. I'm going mentally as I go through this, I'm thinking gross wages. So it's right off of your general ledger. It's not off your W-2.
I would suspect gross wage as well, because they talked about being able to include those other compensation costs like retirement and all, and that would not be in box 1. But these are great examples of where we need an FAQ on this, just like Kristi has now on the DOL side. And as we said, that document Kristi's referring to has had questions added to it on 3 separate occasions. But these are all going to be questions they're going to get, and I don't think they're going to leave that to the interpretation of all the banks.
No, I don't think so either. I think they'll have it figured out. We'll probably see more definitive answers coming through in the next few days to a week, maybe. Maybe by the next time we do this town hall, we'll have some really good answers for everybody.
All right, I think we'll have time for Kristi. Did you find that answer to your question? You're on mute.
Oh, I've been receiving some information from people. I've just got to pull it together and interpret it. So we will absolutely share out the additional information we're receiving. So thank you to those who have been sending me information, and we'll get something out to you.
Thanks, Kristi. And I do want to point out that we have so many questions that we haven't even gotten to, and all the ones that were answered by Kristi and Chad that were sent out for everybody to see. We're going to work to get those sent out to everybody so you can at least see the questions that were answered there. And I do want to remind everybody that these are being recorded, and they will be posted on our COVID-19 page on our website. So if you did want to go back and revisit and listen to these questions and answers, those will be available to you as well. And there is going to be a survey at the end of this webinar for any comments, concerns, questions. that you want to reach out to that we didn't get to today, please leave us that feedback in the survey. And with that, I'm going to turn it over to Tom for any closing comments that he has for the future town halls as well as this one.
Okay, well, thank you, Kaylee, and thank you, Steve, Kristi, Chad, and everyone else for your participation today. As you can all tell, there's just so much information to make our way through. This act is only about 4 or 5 days old. Much reading and much has come our way since then, but so much more to come to clarify all these answers. So we are going to continue to keep our heads down for the next several days, maybe even weeks, to learn as much as we can and share that with you. So as we said, keep your eyes on your email, keep your eye on our website, keep your eye on social media, and certainly please plan to join us again next Tuesday, April 7th at 2 p.m. Eastern. Any questions you have in the meantime, reach out to any of us or your SN rep, or contact us at the contact page at SN. As Kaylee said, we have a lot of questions to still get through, and we're going to be doing our best to get through them and answering each of you individually on those. And also, if there's common themes on that, get that information distributed out to you as well. So again, we hope that you all stay well, stay safe, keep doing what we're doing, and hopefully together we will kick this thing as soon as possible and get our lives back to normal. But until that happens, we'll be here for you, and we look forward to seeing you again next Tuesday. So thank you very much.